Talk Money to Me is a financial podcast produced by TransGlobal. All opinions expressed by the host and guests are solely their own opinions and do not reflect the opinion of TransGlobal. This podcast is for educational purposes only and should not be relied upon as basis for investment decisions.
Hey everybody, welcome to Talk Money to Me, where we talk about money and how it affects you. I'm your co-host, Jonathan, and I know a little bit about finance.
And I'm your other co-host, Tracy, and I know almost nothing about finance.
We have two wonderful guests with us today. I'll go ahead and let them introduce themselves.
Hi everyone, my name is Jason, and I have 8 years in the insurance industry.
Hello everybody, my name is Richard Wang. I've been selling life insurance and annuities for roughly almost 10 years now.
So today's topic is insurance. More specifically, insurance as an alternative investment, which confuses me. When I think of insurance, I think of something that helps me to mitigate risk. So what that means is if I buy car insurance, then if I get into a car accident, I might be protected from having to pay an extraordinary amount for any issues with the car insurance. Same with life insurance. I think of it as if I die, then or lose my life, then other people can benefit from it and not suffer as much loss as they would have. And so life insurance to me is something that is triggered by catastrophic events that I hope don't happen to me. And so much like AppleCare, I think I don't have to buy it because nothing catastrophic is going to happen to me. Can someone enlighten me on how insurance can be an alternative investment?
Sure. Going off of what you were saying, Tracy, a lot of us traditionally think that insurance is going to be the auto home insurance, and then life insurance is, you buy it for somebody, and then if you ended up passing away, then you have a death benefit that pays out. Well, what people really don't understand, though, is life insurance also has other different types of products that can also benefit you from an investment perspective. Some people will actually buy life insurance and actually use it for their retirement as well. So the traditional types of life insurance that we think of are going to be what's called term life insurance. That's going to be basically purchased in increment of time, which could be from 10 years, 20 years, or 30 years. At the end, what happens is that policy will run its course. And after the 30 years, I no longer have any insurance. And even though I did pay premium year after year, I don't really get anything out of it.
Wait, pause. I want to clarify. So for term life insurance, it's possible for you to pay for 30 years and get nothing for that money. Yep. You could die at 31 years and nobody would benefit from the millions of or thousands of dollars you put into that policy?
Bingo.
I will never ever buy term life insurance.
Since you had mentioned, Jason, that there's these things called term life, what is new or different about life insurance today that makes it something that would be a good consideration as an investment?
There are other types of life insurance products that I've come to learn about. One is very popular nowadays. It's called Index Universal Life, and another would be Variable Universal Life. That's something that I think Richard has more insight on.
Basically, with an IUL is that a percentage of the money that you're paying into your life insurance, a portion of that is going to be going into something that mirrors the stock market, but you are not inside participating in the stock market. When inside that instance when the stock market grows, a portion of that premium that you've paid that is inside this index, what we call it, the index that mirrors the stock market, when it grows, your money grows. But the best thing about life insurance, IULs, what we call them, Index Universal Life, is that if the stock market drops past 0%, you don't lose those earnings.
Basically, you're saying that instead of throwing away your money to term life insurance, as I now am going to call it, throwing away your money, what the insurance company is saying is, no, wait, you should still buy life insurance, because what we'll do is you can let this money that you've put into us make money, right? Like an investment, like a stock, at its most basic, they could put your insurance premium into an engine, like an index, like what you just said, what you called an index, and that index will mirror the stock market and make your money grow or drop. But Index Universal Life protects you from losing any money.
That's correct. And piggybacking your comment, where we're having a 0% floor when the market drops, we have to naturally give something up. My parents have always told me there's no such thing as a free lunch, and you better believe that the insurance company wants a piece of theirs. So what they would generally do is put a cap on a certain product. So let's say if it's 10% cap, meaning that anything that goes past 10%, the insurance company is going to keep it. So in this kind of aspect, you can think of it as the insurance company and your own life insurance policy, we're all running towards the same direction. The insurance company has incentive to make sure your policy hits that cap, because anything extra just goes back into their pockets.
So if that's how an indexed universal life policy works, then what's the difference between that and a VUL, like you mentioned?
A VUL, very quickly, the only thing that's different would essentially be that there is no zero protection. But what you are essentially getting back is almost infinite growth, if there was ever such a thing. So the trade-off is, though, you're losing that 0% floor, meaning you can go way past if you lose. But the upside is that you can gain a significantly amount of cash value if you are able to take care of your variable universal life policy correctly.
As a risk-averse person, an index universal life sounds amazing to me. Index universal life could be a great solution for someone who just wants to make a little bit and wants to be 100% safe. Does that sound accurate?
Absolutely, but I do want to make mention, there are going to be years that you will see a 0% return. We're not going to see where every year you're going to get growth. And we also have to remember, when we are utilizing life insurance in this aspect, either to pay for college or to retire early or to use it in aspects when we get sick, it all depends on the fact that we are able to utilize the tax-free benefits that comes in part of what a life insurance is.
How can we get money from a life insurance policy before we die?
So as the life insurance policy generates income, we have to remember every time you pay premiums, a certain amount of that money is going to be going into that index, what we call that mirroring the stock market. And as you pay every year, that little bit of amount starts to compound. Every year you're adding to it. Every year it's inside the market earning. So by the time you are ready to use this cash value, you're able to take out what we call a loan. And this loan is going to be, for example, they're going to charge you 5% on whatever you take back. But what's special about this loan is that any kind of growth can negate the loan. Meaning, if I'm getting charged 5% for a loan, but my policy returns 10%, I made a 5% spread. That 10% got cut in half, took care of the loan. The other 5 just goes back into my policy growing.
Mm-hmm. So it sounds like while you're alive, you can take the value of your life policy, take that money out and use it. The insurance company will charge you some money to take that money out. But if you are fortunate enough that you continue to have the money in the index grow, then it essentially covers the cost of taking that money out.
Absolutely. It's called, what we call it, a participation loan, or an index loan if you want to get fancy.
If you take money out, does that affect the death benefits?
Absolutely. The death benefit and the cash value is in correlation with each other. And the reason for that correlation is for the tax-free benefits that we receive. If that correlation ever breaks, then the money that we decide to use will now be considered taxable income. So what do I mean by ratio between cash value, death benefit? Let's say you're very fortunate and you buy a life insurance policy and you hit the lottery. You finish paying the premiums, you never have to touch that cash value. What eventually will happen, if you don't touch that money, it will start to mirror the death benefit. The more cash value you start to accumulate, the more of your death benefit will start to grow. There are numbers that you will eventually be able to see at what age, hypothetically speaking, your death benefit will start to increase to start to match the cash value.
Jason, you had talked about how we have home insurance, auto insurance, health insurance, and a lot of what we've covered so far is about the benefits that come with a life insurance policy. Are we able to use other types of insurance as an investment tool as well?
As far as getting monetary gains or returns from it, like for example, like your traditional auto and home insurance, the short answer to that is no. But can that actually help you in general, as far as just maintaining your financial portfolio in general, I would say yes, because when you own assets, at the end of the day, those assets become liabilities. Now, if you don't have some sort of protection to cover yourself or protect yourself in case of a loss, then those liabilities can end up translating into large amounts, like dollar amounts. So what I'm trying to say is, let's say, for example, I own a house, but I never bought insurance on it. Now, let's say there was a brush fire, because there's tons of brush fires that happen in California, right? Let's say one day my house burns down. Now, if I didn't have insurance, then I would have to pay out of pocket hundreds of thousands of dollars just to go and either, rebuild my home or to buy another home. But by having home insurance in place, all I did was pay, my insurance premium, as well as maybe my deductible at most. And then the insurance company will in turn help me to repair my house. So I know that doesn't answer the question directly, but as far as someone, such as myself, who has been in the industry for so long, I've come to realize that even though you're not actually getting monetary gains from this particular insurance, it's still in a way helping you as far as protecting your investments and protecting your assets.
It's a better safe than sorry. That's what I'm hearing.
Yeah.
As someone who is notoriously indecisive, I guess what I'm seeing insurance now, based on what you guys have told me, and I'm still processing some of the information that you guys told me, but is that it makes the money that I put into an insurance policy more flexible in what I want to do with it, right? It sounds like as it's growing, right, either it'll start to impact my death benefit, so that, like, if I never use it, then potentially that could be a really huge benefit for my beneficiaries, right? Or in life, if I encounter some catastrophic event where I need to withdraw money, or I need a chunk of money, I had money in there already that I could potentially use to sort of make, I don't know, like losing my job or some other life event less painful. So my question is, what are some other applications of like these types of life insurance policies? Like, what am I not thinking of? Because originally I thought I had to die.
Well, with these kind of IUL policies, they are able to take care of a variety of things. And I want to make mention as well is that the biggest advantage of life insurance is the flexibility. The flexibility in how much premiums you pay year to year, and the flexibility of how and when you want to use this cash value inside your life insurance policy. There have been people who have been planning this for their children. They pay X amount of years for 18 years when their child is first born, when they're 18 going to college, and then eventually at the age of 65 taking out the same income. There are some policies that are designed for, let's say, should you get sick. Certain policies called long-term care or living benefits that are included with life insurance that will basically take care of any kind of medical emergencies that you would run into.
Oh, that's awesome. So what is a good age to start really thinking about buying life insurance, either for yourself or for the people in your life?
Well, if it was for me personally, I think the sooner the better. I think of life insurance as something that, yes, although it is to protect my family should something happen to me, but I feel that the amount of money that I put in premiums paid inside a life insurance policy performs much better than what the savings account that I have, and is definitely much safer than me going out buying options or playing in the stock market. And people don't think of life insurance as a sexy term, right? It's not something as fancy as bonds or stocks and options. And it is a more of a unconventional way of thinking about what life insurance is now. Especially if we talk to our parents about what life insurance is, they're going to tell you what you just told me, which is something that we only use when we pass away. But life insurance now has evolved into so many different varieties that can fill into so many different needs.
Are there things that we might want to watch out for or know ahead of time before we get in?
From my personal experience, I know that regardless of what type of life insurance product you're getting, the insurance company is still going to want to make sure that for the most part you're in good health, such as, not smoking, not having any pre-existing conditions or any type of serious health conditions, because ultimately that will affect your insurance premium rate, as well as your eligibility to even be able to purchase the policy.
If I was going to part with some advice, I would want all of your listeners to when they're being approached with the idea of life insurance, you have to make sure that the agent themselves are asking the right questions. It's never going to be about what a product is first. It's going to be about what your needs are. Are you worried about retirement? Are you worried about not being able to financially support your children when they go to good colleges? Or how about, are we talking about when you get into retirement, using up your retirement money because you got sick and now you're working a menial job, right? And we want to make sure that we want to understand what the client's main needs are, what their risks are before a product is mentioned at all.
That's actually really great to know that the questions that get asked are going to be focused more on what do you need? So this is what will fulfill those needs instead of here's all the cool gadgets and gizmos. So with that, I will draw us to a close. Thank you so much again, Jason and Richard, for joining us today on our podcast. And with that, we will be ending Talk Money to Me. See you at the next episode. Bye.